After evaluating macroeconomic conditions, the industry, the product, and the team, next we spend some time understanding a company's numbers. Specifically, we try to understand what the numbers say about the company and its performance so far. Here, we're typically looking at the following: the income statement, the balance sheet, the cash flow statement, and the company's unit economics. It is important to note before diving in that the terminologies and examples I use in this module will be specific to lending businesses. Please look to supplemental material and other resources for content and examples that are generalizable to other types of businesses. First, let's take a look at the income statement. The income statement is a statement showing a company's revenues and expenses over a specific time period, letting us know how much money the company made or lost during this time period. The income statement is typically broken down into sections in the following manner. It starts with the revenue. This is the amount of money a company earned for services rendered during a specific time period. For lending businesses, this is typically broken down into interest income, which is the amount of money a company earns in interest from lending activity, and other income, which is the amount of money a company earns for other adjacent activities. For example, if a business charges a one-time fee to its customers, this fee income will be recorded in the income statement. The result from this part of the income statement is the total revenue that the business earned in this time period. The next section details the company's financial expenses. For lending businesses, this is made up of interest expense, which is the cost of the capital that the company is lending to its customers. Loan provision expenses, which is the amount of money set aside to account for the possibility that some loans will not be recovered. And other expenses, which are the costs directly related to lending activity. For example, the amount of money paid to payment processors, such as Stripe, for the work of sending money to the customers and collecting money from the customers. The result of this part of the income statement is the total financial expense. With these two sections, the net financial income is calculated by taking the total financial expense from the total revenue. This represents the net amount earned by the business that is directly attributable to lending activity. The next section of the income statement details the operating expenses. This typically represents expenses related to the running of the company. For example, salaries, marketing expenses, office rent, etc. With this information, the total operating expense is calculated. And with this, the net operating income is calculated by taking the total operating expense from the financial income, from the net financial income. This net operating income represents a company's income after operating expenses are deducted. Next, any non-operating expenses are taken out, for example, foreign exchange losses, and taxes are taken out to give net income. And net income is the main indicator of a company's profitability. A positive net income means a company's revenues exceeds its expenses and that it is profitable. A negative net income means a company is loss-making. We are the most comfortable lending to companies that are net income positive, as this is a good indicator that the business makes enough money to comfortably service its debt. But this does not mean that we only lend to companies that have positive net income. We sometimes are comfortable lending to companies that are net income negative as long as their net financial income is positive, their unit economics positive, and I speak about unit economics later on in this module, and they have enough equity on their books to cover their losses. I speak about equity later on in this module as well. So that does it for the income statement. Next up, we'll be talking about the balance sheet. Thank you.